All right, the very last thing we are going to cover in this class, yes, you've made it, is ratio analysis. And ratio analysis are figures that provide management with key information about how the company is doing. Now, we call it ratio analysis, but it's not always ratio. Some of them are ratio, some of them are just figures. So, ratios can provide important information for decision making. Okay? So, they can be used to determine a firm's liquidity, borrowing capacity or ability to borrow, and its profitability. Okay? Now, some of the ones we're going to be talking about, the liquidity ratios, include, okay, what's working capital, okay, the current ratio, the quick ratio, and there's turnover periods. One is the inventory turnover period, and the other one is the accounts receivable turnover period. All right, so liquidity ratios and values show the ability of the company to pay current liabilities without having to borrow. Okay, so the ability to pay back their current liabilities. Now, the first one we're going to talk about is working capital. Working capital is equal to current assets minus current liabilities. Now, a large positive working capital shows that a company has the ability to repay its short-term debts. Okay, just makes sense, right? Now, that's not always the case, though. Okay, you could have a large positive working capital and be unable to pay your current liabilities. And why? Why would that be the case? One reason is the majority of your current assets is tied up either in prepaid expenses or in accounts receivable. Okay, so there are reasons you may not be able to pay your current liabilities as they come due. All right, the next one is the current ratio, and the current ratio is basically your total current assets divided by your total current liabilities. So in this example, okay, we have $170,000 in current assets and $60,000 in current liabilities. And we ultimately get an answer of 2.8. Okay, I'm not sure if that's the correct answer, rounded, but okay, to one decimal place, I'm sure it is. Okay, so if we get an answer of 2.8, okay, the way we read it is 2.8 to 1. Okay, so our current ratio is 2.8 to 1. Now, how do we read this? It ultimately says that we have $2.80 of current assets for every $1 of current liabilities that we have. Now, there's also something called the quick ratio. And the quick ratio, or the asset test, okay, or the cash ratio, only includes the very, very liquid assets. Okay, so it includes only cash, accounts receivable, and marketable securities like stocks and bonds or GICs or that kind of stuff. Okay, divided by total current liabilities. Now, a quick ratio, okay, in our example here, we have $80,000 of very liquid assets divided by $60,000 of current liabilities. So we get an answer of 1.3. So for every $1 of current liabilities, we have approximately $1.30 of very liquid assets. Now, a couple of things, okay? For most companies, okay, a current ratio of 2 to 1, we're going to assume is acceptable. And for a quick ratio, for most companies, anything above 1 to 1 is we're going to consider acceptable. Now, the next one is inventory turnover period, and it indicates the time it takes for a company to sell and then replace in its inventory what it sold. Okay. Now, if inventory is too high, okay, there's problems because we have to pay storage costs, right? And okay, that reduces our profits. So we don't want too much inventory, but we don't want too little inventory either, because if we have too little inventory, that could mean the loss of sales. If somebody comes into the store or the business and can't find what they're looking for, or it's not there, then we're going to lose that sale. Now, the inventory turnover period basically helps lenders to determine how fast merchandise can be converted into cash. Now, different types of businesses have different normal inventory turnover periods. So, for goods that are perishable, like fruits and vegetables, you want a very short inventory turnover period. It's not going to stay on the shelves very long, right? And not go bad. But if we're talking something like an expensive painting or an expensive automobile, those normally have a much longer inventory turnover period. It's not like a Ferrari dealership sells a Ferrari every day, right? So it might sell a Ferrari every 14 days, right? So the inventory turnover period does differ between companies. Now, for our purposes, an inventory turnover period of 35 to 45 days is going to be acceptable. So how do we calculate it? Okay, we take ending inventory and divide by cost of goods sold and multiply by 365. So in this example, we get an inventory turnover period of 38.6 days. And since it's within our range or lower, then it's acceptable. Okay, so people who issue credit like to see a short turnover period. So that means we're selling our inventory quickly. Now, there's also something called an accounts receivable turnover period, and basically what that indicates is how long it takes us to collect our accounts receivable on average. So anything between or under 45 days is acceptable for most businesses. Okay, and this is how we calculate accounts receivable divided by net sales on credit. So that means, okay, only on account, right? Now, for most of the questions that are in the homework, okay, you have to make that assumption that all sales are on credit. All right. All right. There's also something called borrowing capacity ratios. There's the equity ratio, and there's also the debt ratio. And basically, the two together equal 100%. And the equity ratio is the percentage of the company that has been financed by the owner himself or herself. So that means not using borrowed money. Okay? And the debt ratio is the percentage of the company that's been financed using borrowed money. Okay? So if you know one or the other, you know the other one as well. So if the equity ratio, the percentage of the company that has been financed by the owner is 60%, that means the other 40% has been financed using borrowed money. Okay? And if you know that, I don't know, 41% of the business has been financed using borrowed money, okay, then that means 59% has been financed using their own money. Okay, now an owner of a business favors low equity ratio and high debt ratio if the interest rate is low, right? Because it's cheap to borrow. Now, a lender prefers a company to have a higher equity ratio, and the reason is lenders want to know that the person applying for the loan has some kind of or has skin in the game, meaning they have something to lose, because they'll be more likely to work harder to make sure that the money they're borrowing, um, sorry, they want to make sure that the business does well, because a lot of their money has been financed, or a lot of the company has been financed by or using their own money. So they want to make sure that business does well, because they don't want to lose that money either. All right. A couple more. There's also something called the rate of return on net sales, and this indicates the percentage of sales that represent profit. So, okay, there's the equations up here. I'm not going to go into it. And there's also something called the rate of return on average owner's equity. And basically, that's what the return is for every $1 that the owner puts into the business. So what kind of a return is he or she getting for every $1 he puts into the business, or she puts into the business? Now, it's a two-step process. Okay, first you find the average owner's equity and divide by 2, or by taking the beginning inventory and ending inventory and dividing by 2, and then finding the rate of return on average owner's equity by taking the net income and dividing by the answer in step 1. Now, the thing is, the rate of return on average owner's equity has to be higher than the rate of return the owner would get from other forms of investment. So, for example, what's the point in putting what's the point in starting a business if you're only going to get a 2% return on every dollar you put into the business? Because you could simply put your money in the bank and kind of get that kind of return. So basically, you have to weigh the risks out, and how much of a return you're getting back. Nobody's going to start a business and only get a 2% return on their investment when they could simply put their money into a bank account. Alright, so the rest is just a matter of doing questions.